I want to turn it over now to Julia LaRoche, who is going to be interviewing the Chief Investment Officer at DoubleLine. Julia?
Well, thank you so much, Kristen. And Jeff Sherman, the Deputy CIO of DoubleLine Capital, thank you so much for having us here for your investor days. Let's start with the markets and your overall view and what you're paying attention to right now.
Yeah, it's been the case all year. Our focus is on interest rates at this point. We had a big rally last year in rates. The bond market had extraordinary performance last year, whether you look at the credit markets, you look at longer duration assets. And so coming into this year, again, given the policies underway, the Fed's commitment to a long-term commitment to very low interest rates, at least on the front of the curve, and then essentially the repricing of growth and inflation back into the marketplace. And so one thing that we've really been focused on is trying to really gauge where interest rates are going, trying to understand the dynamics, and what a week for data to really talk about interest rates. And so that's one of the big top of mind issues in the markets today.
Well, yeah, a lot of focus right now on rates, and you're right. And the data that we got this week, the CPI print yesterday, and a lot of concerns around inflation being a big topic. Is it transitory, or is it going to be more rampant? What's your view as it relates to inflation?
Yeah, I think it's way too early to dismiss transitory, because the first thing is we all expected a significant print or a significant uptick in the CPI year-over-year numbers. But what was really shocking to us as well as others in the marketplace was that the month-over-month print was quite significant. And why I say the year-over-year is the base effects. Remember, we're measuring from really last March, the lows kind of in inflation data as well as growth last year. So what you saw was a big month-over-month change. And a lot of that has to do with the prices of goods, right? As you'd expect in inflation. I mean, we talk about cars, leisure. You're seeing big uptake. You saw airline tickets be a big mover in the last month or so. So to say that it's transitory, I think is to dismiss what's happened there. And why is this, Julia? Well, what it is that we've mailed a lot of money to the consumer, right? People are vaccinated. They're opening the economy back up. People are traveling. And so you're seeing all of this consumption take place. And, a lot of people positive would go into markets, or we saw that with the first stimulus checks. It seemed to be correlated to the markets. People also save. When you get the first or second stimulus check, you save it. They're one-time or two-time events. But by the third time, you start to say, wait a second. The government's going to keep mailing me money every few months. So you know what? I deserve this. And you know what? America does deserve it right now. They've been good. In general, we stayed home. We've done this. And people are opening back up. So you're seeing that in the consumption data. So to dismiss this as transitory, to think that the Fed knows best, that it's going to be, I think it's way too early to tell. So, it's one data point, doesn't make a trend. But I think the more important thing to say is, okay, let's watch the next couple of months. And that's what we've said here at DoubleLine for the last 6 or 7 months.
Well, certainly something to pay attention to. But from a portfolio allocation perspective, how are you thinking about inflation hedges, where you might want to be protecting yourself for that risk?
Well, in the fixed income market, I think the TIPS market is pretty overvalued today. And so the expectation's already built in. If you look at the 5-year TIPS or the break-even rate, how the market's pricing inflation, it's priced to be about between 2.6 and 2.7% per annum for the next 5 years. Now, we did see a 4.2 print yesterday, but if you think about going forward, historically pre-crisis, we were talking about a 2% type of inflation rate. So the market already has some expectations in there. And in order to continue to have these inflation rates, you need to have strength in the commodity market, strength in consumption, and we need to have wage growth. So I think the market is somewhat fairly priced on that side. So I really don't think TIPS are the best way to kind of hedge a fixed income, but instead focus on duration. Why do I say duration? Well, if we're going to get more inflation data, it's going to put pressure on rates. The easiest thing to do is shorten up your exposure to rates. So that's something that we've been doing, and we started to resculpt the portfolios last month and reduce some of our duration. We were playing a counter trend rally in the rates market, and what happened is we had massive negative macro headwinds last month. You see the European data, the vaccinations, the shutdowns again. You saw essentially the uptick in the emerging markets with their COVID cases and the deaths in India. I mean, just horrific news. And the rates market moved in about 20 to 25 basis points. So we looked at it and said, okay, that was the rally, time to reposition again. I think investors have time.
Well, we often talk about, and Smart, you mentioned time is really important. We often talk about, fixed income markets with you guys, but you also do focus on equity markets. Talk to us about what you're seeing in that space and where you might want to be within the context of the equity markets.
Yeah, well, just like I talked about in the fixed income market, what worked last year isn't working out. Duration or interest rate exposure. Same thing in the equity market. What worked last year? The stay-at-home stocks, the shutdown stocks, the things that were technologically related, high-flying growth stocks. And so what you find is with a resumption and a reflation of the economy, a resumption of economic activity, people are rotating, right? So we saw this from the announcement of the vaccination in news in November. Since that point, there has been a change in leadership. Look at the markets today. Growth stocks are about to go negative at this point. If you look at, let's say, the NASDAQ, right? But the Dow keeps leading. So what this is a change in leadership. And what your value manager has been saying for many years is finally coming to fruition. And I agree with them. When you look across valuation, you want to be exposed to these cheaper parts of the market, but you also want to be exposed to things that are in the cyclical expansion. And what some investors don't realize, cyclical doesn't mean growth stocks. Right? They're industrial. They're things that are correlated to the economy, but not necessarily would have been the high-flying stocks. So to us, the value rotation is real, and it should persist at least for the next 12 to 24 months.
Yeah, definitely a story that folks have been, will be talking about and continuing to pay attention to. I want to ask you about crypto. Just generally, what are you inferring from what is going on in the crypto space right now, the price action that we're seeing there?
Yeah, I mean, the crypto markets are a speculative asset, right? A lot of people will come out and say, okay, do they have purpose? Do they not? Think of what's happened with Dogecoin or something, right? Where it was created as a joke and became this high-flying, very valuable asset. And so what I don't have a strong opinion about cryptos one way or the other, except they are a barometer for risk-taking. And as you've seen, high-flying growth stocks suffer, so have cryptos a bit. So I think there's a lot of noise in there. There's a lot of nascent players in that market, and potentially there is some viability for it in there, but it's a perfect risk sentiment type of trade. Notice when risk sells off in equity markets, like cryptos tend to go down as well, and vice versa. So I think that's the best way to think about the crypto markets. It's really a levered play on risk assets. It's highly volatile, and it tends to be highly correlated to those assets.
Well, Jeff Sherman, Deputy CIO of DoubleLine Capital, I thank you so much for having us here today. And be sure to tune in at 4:15 p.m. Eastern for our exclusive sit-down with DoubleLine Capital's founder and CEO, Jeffrey Gundlach. I'm going to hand this over to Kristen now. Kristen?
All right, Julia, thanks so much for bringing us that interview.